I'm curious what you think about Bitcoin's CAGR. So depending on what time period you take a look at, right, maybe it's a 50 to 60% annual compounded annual growth rate over the last 3 years, 3 to 5 years, maybe 85% if you go back 5 years plus. The general rule of thumb seems to be that the law of large numbers says that that number continues to decelerate, and we go from 80 to 60 to 50 to 40 to 30, et cetera. What do you think about, or have you thought about the potential for CAGR to actually start to reaccelerate again? And the reason why I ask that is if you think about like traditional assets that would be probably started from a venture capital round, and they've got all the private equity money in before they go public. And then you start having retail, which is small incremental money that kind of comes in. And so as the asset gets bigger, it's big checks first, small checks later. Whereas like Bitcoin seemed to work the other way around, where it was little checks in the beginning. And today, to your point that you just brought up about the Bitcoin treasury companies, now we have billions of dollars of buys coming in at a time. And so now with the treasury companies, with the institutions, as you mentioned, the ETFs, with even sovereigns coming in, could we be sort of, looking at technology with an S-curve type format, could we sort of be in that parabolic phase with the big checks coming in that could potentially invert Bitcoin and see that CAGR start to accelerate it again a little bit?
I think what's offsetting that hypothesis, Mark, is that you've got now, in the early stages, spot buying only. And you had the sort of the uniqueness of the hard cap as well with the declining inflation rate. Mm-hmm. That was perfect for parabolic rises, especially when it was just the plebs, us buying it. Then as the network evolved, and I guess more sophisticated players,
the futures, the options, etc.,
suppressing the volatility. So I even look at the research that I do. I look at the elasticity of Bitcoin to changes in liquidity, which is, anyone who says there's a perfect metric or a perfect correlation in financial markets doesn't understand financial markets, because markets are non-stationary. But at least historically and still today, the relationship with liquidity is statistically extremely significant, but it is moderating over time. And so looking at sort of just the last couple of years, Bitcoin's elasticity to the changes in liquidity is less this cycle than in the last cycle, but not by a massive amount. And just where we are in the liquidity cycle is typically when you start to see a real uptick, and therefore the elasticity generally expands also during this period, but more so in the same sort of scenario from previous cycles. So I just look at that and I think, okay, you've got suppression of volatility, and you've got just the maturation of the market, and the sensitivity of the asset to the drivers of the price starting to decline. So I am in the camp that we start to see CAGRs moderate over time. But it's going to be interesting because there will be explosions of volatility in and along the way. And if you look at why you invest in the S&P 500 from a traditional portfolio management standpoint, is that you stay allocated, because if you try to time that market, generally like 80%, 90% of the returns come from like 10 trading days in the year.
Right.
Same applies for Bitcoin. And we will see like massive volatility expansion at certain times, like we saw in 2023 with the bank bailout, and the first time that Bitcoin basically gave the signal that this is a systemically integrated asset with real risk-off characteristics, because the interbank market exploded. Bitcoin always fell in those scenarios. It didn't that time. So it was another sort of proving point. And I think we'll see a lot more tests like that where Bitcoin will show that it is truly a risk-off asset, and sort of shrug the criticism that it's just it's a risk asset correlated to the NASDAQ, which is not true.
Yeah. I mean, certainly in the last 5 years, the Sharpe ratio has been much better than U.S. Treasuries. And we can see how since the introduction of the ETFs, the volatility has really come way down. So it's like we could just continue just sort of being boring and just continue creeping higher and higher and higher, maybe. You mentioned the global liquidity and some of the elasticity that's sort of diminished there. Real Vision, Raul talks a lot about global liquidity flows and sort of this potentially 8 to 12 week lag that Bitcoin might have to that global liquidity move. And so when you look at this global liquidity move right now and then adjust for this lag, I mean, it looks like there should still be another big leg up in front of us.
Yeah. I mean, the problem with using the lags is that markets are non-stationary, so it'll change over time, but directionally it should play out. Unless there's something fundamentally different about this asset that we're not aware of, and that it's not tied to, the increase in marginal new units of currency in the financial system, which I don't believe to be true. So the problem is that Twitter has attached itself to this chart. I think it's been the most shared chart of 2025, and it's fixated on the lags. Raoul said this many times, and I would certainly say it as well. It's like, if you're trying to invest on one chart with one correlation fixed with a fixed timeline that's been working for the last 2 years, then you're gonna come unstuck.
Yeah.
But yeah, you're right. Like that the divergence between the two is expanded, and it's not just M2, which I think is the most shared sort of version of that. It's total global liquidity.
Right.
So you're looking at central bank balance sheets, you're looking at the impact in the shadow banking market and everything else.
Yeah. So when you look at that, and to your point, certainly don't just focus on one indicator. But if you look at that plus a handful of other indicators that are commonly used, like MVRV scores, for example, or even if you want to look at Fibonacci lines, which I don't really put a lot of credit towards those things. But you look at some of these NRPL scores or whatever, it does sort of look like Bitcoin is maybe halfway through its cycle. Like from a is it expensive? Is it cheap? You look at the M2 lag. If you look at, again, these types of indicators, you've mentioned that, from a static time frame, like October, November sort of peak from a time frame, but from like I said, all these on-chain indicators, et cetera, it looks like maybe we're like halfway through. And so again, that's from a static view. Now we could see Bitcoin go on a $30,000, $40,000 rip, which would then put it to the very top of the peak real quickly, which then maybe does make me think, well, maybe it does hit that M2 lag. We do pop up. We do end up magically right in November here at the top of cycle, right?
Yeah, I think the best thing for Bitcoin, if you're in it for the long haul, is that you get sort of a moderate increase, because it's when Bitcoin goes parabolic that you generally find the crescendo top, because that's what encourages over positioning, increased leverage, which always gets unwound. And if it's unwound at a time when global liquidity is starting to slow or decelerate, it doesn't have to top. Global liquidity can expand well beyond a Bitcoin peak, and it has in the past. It's really about that subtle change, or that rate of change. But if you have the ingredients of a parabolic rise with a massive explosion in open interest, and MVRV goes up, which is all the unrealized profit in the network, then you have the ingredients to form a top. This peak has been, we saw euphoric tops in intermediate or mid-cycle tops in Q1 of 2024, and I was calling it out then. In Q4 of 2024 again, which I was calling out again, which no one was willing to listen, because the tightening of financial conditions to the US dollar and liquidity was just not supporting it. But where global liquidity is today and where it kind of needs to get to stop anything from happening is still a fair way away. So I think that the trend itself is looking, it's tired because it does rely on liquidity, but we haven't seen a euphoric parabolic rise that would just take the wind out of the sails for the rest of the cycle.